I'm glad you raised the bond vigilantes. And for those watching, they didn't actually have pikes and pitchforks, but they leaned in against countries that appeared to be fiscally reckless. And we're seeing evidence of their bite once again, not just in the United States, where the term premium to compensate investors for locking up their money for long periods has gone up, but also in higher sovereign spreads in a number of countries. For countries where the legislatures can't come together and create a clear discipline around the budget, the markets will provide it for them. And I think that's the risk that surrounds the process here in the United States. There are going to be very delicate congressional discussions over the next couple of months on a bill that would include border security, tax cuts, perhaps some end of spending programs, but the details matter and the politics are thick. So we're watching that very closely. And as you noted, the markets will not be satisfied if the ultimate resolution adds substantially to debt and deficits.
Carl, the 10 picked up to about, I think, 465, right? But, just hours ago, that term premium you just talked about was down to 46 basis points, which is the lowest we've seen at least this year, right? And I also note that, there've been a bunch of sovereign bond auctions over the last couple of days. Not small ones. We had 20s on sale overnight in the U.S. We've had Britain, France, Spain as well. And demand for their paper has actually been pretty strong. So what does this tell you? And how real do you think the risks are of a buyer strike?
Martin, I don't think a buyer strike is likely. Ownership of sovereign assets is a bedrock of a lot of portfolios. And as you know, it's kind of a benchmark against which asset class returns are often gauged. But a strike is very different from asking for a little bit more yield. And yes, in the last couple of days, things have moderated a bit. But if you go back to last December, global long-term interest rates are up quite a bit. Fixed income volatility is up quite a bit. The equity markets are starting to notice just a little bit more. And it just illustrates what Sri asked about, which is how delicate that balance is between trying to do what you want fiscally with taxes to promote business creations and also being aware that you're reliant on the world's investors to finance all of those operations.
Got to ask you, Carl, the calculus or the math that Trump is trying to enact. Tax cuts, funding, paying for them, tariffs, that's not going to cover the whole bill, right? There's going to have to be cost cutting. That's Doge minus Vivek Ramaswamy. I guess Musk is on his own on that. Also deregulation. Is it all going to add up?
Fiscal math is quite mysterious. In fact, it's referred to in many circles, Martin, as fuzzy math, because it isn't just the cost of the programs, which are hard to calculate, but then you have to carry it through what implications it will have on economic activity. This is what we call the second order effects. And those are very, very hard to gauge. History isn't a great guide. And of course, the lens with which you're looking at the problem sometimes determines the size of some of those reaction functions. So fortunately, I think the best user's guide is to look at a variety of projections and ranges before you make an assessment of how all of this will sort out. With regulation as well, how beneficial is that going to be to output and prices? It's very hard to come up with a rigorous way to assess all of these moving parts.